Hello and welcome to the latest in our Insider interview video series. Today I'm joined by James Dow, who is fund manager of the Baillie Gifford Responsible Global Equity Income Fund. James, thanks for your time today.
Thank you for inviting me.
Income funds have different approaches. Some target high-yielding dividend shares, while others focus more on dividend growth and are less concerned about what the yield is today. Your fund falls into the latter camp, so could you explain why you focus much more on dividend growth?
What it boils down to is the results we believe it will deliver for clients in the long term. Our view is that if you focus on dividend growth rather than dividend yield, you end up with more income actually over the long term, better capital growth over the long term, and you get a much more resilient outcome. So the challenge with the high yield stocks is that typically they're coming from businesses which are ex-growth. They're really struggling to go anywhere. Tobacco, oil, British Telecom, they're very mature, plodding businesses. And often they can be quite risky. They might have geared up with a lot of debt. They can be quite deeply cyclical. And if you're an income investor, that you've got to really mind your eye. The yield looks attractive today, but think about your holding over several years. Often it ends in tears, to be honest. So our view is you're much better off for the long term, sacrificing a bit of yield today, coming back down the yield spectrum and focusing on those companies where you really believe there's good growth in profits and dividends over time. So a classic example of that we've owned for years is Microsoft. It's a company which it's never had a dividend yield that's looked particularly high or attractive, but it's definitely been a great dividend growth stock. It's well managed, cloud opportunities, now into AI, throws off loads of cash. And if you look back over time as an income investor, what do you actually get from Microsoft the past decade, say, compared with some of those high yielders? I mean, there's no comparison. You've got more income actually over time. You've got much better capital growth, whereas the others have gone sideways. And it's been a lot more resilient. You haven't had to worry. We talk a lot about our clients, about income clients in particular. They want to go to sleep at night. They don't want to think, oh, my portfolio, is that thing going to blow up? And I wake up tomorrow morning and there's no dividend. You're much better off for long-term outcomes, for resilience, in our view, by focusing on dividend growth companies.
So what would your response be to an income seeker that's looking at the fund today? It has a yield of 2% and other funds have higher yields. How would you convince them to back your strategy?
Yeah, I think we'd say when you're looking for income, ask yourself the question, where do you generate that income? Do you purely generate it off dividends or cash interest or something like that? Or, and I think this is what most income investors do you sometimes draw down capital to be able to fund income? Do you spend some of that capital growth that you've got in your portfolio and say, hey, well, look, it's grown by that, I can spend that amount and I'm still at zero? Our experience is that actually most income-seeking investors do a blend of some income generation, but they're happy to spend capital growth as well. So what I say to the investors like that is, if that's what you're prepared to do, which would you rather have? Would you rather have a 5% yielder, let's say, which is kind of going nowhere? Or would you rather have something with a 2 or 3% yield, but you might be getting 6 or 7% capital growth, maybe even higher? If you think of the totality of the return you're getting, you're going to be much better off, even as an income client, going for that lower yielder that's growing. So that would be the mindset that I would advise people to take when they're seeking income.
For the first time in a long time, equity income strategies now face greater competition from other assets, such as cash and bonds, which have seen their income increase due to the rises that we've seen in interest rates since the end of 2021. How would you make the case then for global equity income versus cash and bonds?
Right. So I think a key thing to think about here is inflation. So yes, cash rates have gone up, but why have cash rates gone up? Well, they've gone up because they're having to compensate investors for higher rates of inflation. We're probably in the UK, probably looking at maybe 5% on average, something like that this year. We've obviously been higher. So yes, you could put your money into cash and let's say you earn 4 or 5%. But of course, your spending power might at best have remained flat it might even have come down a little bit with inflation. So are you actually growing your savings? Are you growing your future spending power? The advantage of investing in equity income, yes, your yield might be a bit lower today, but if we do our job right, we are going to be delivering capital growth to you over time. Companies that are growing their earnings, growing their share prices. So for an inflation environment, you're much better off owning something with a bit of a lower yield, but you're getting that capital growth. You know, we aspire to own companies that can grow their earnings 10% for a decade. If that came through in share prices, you're getting your 10% and let's say a 2 or 3% yield, you're beating inflation. You are actually increasing your spending power. You are actually, growing your savings pot. So although it looks optically more attractive to go into cash, think about the long term, think about inflation. Our view would be equity income is a much more compelling place to be.
And would you apply the same argument to bonds as you've just made for cash?
Yes, so bonds have the challenge that they're a nominal asset. They're not going to turn around and pay you a higher coupon, and your capital, is going to be eroded by inflation over time. So again, looks more attractive in year one, but think about inflation, think about the long-term outcomes. Our advice would be for a long-term saver, investor, for someone with a long retirement, equity income is going to be a better place for you to be, most likely.
I wanted to next ask you about one of the hot areas of the market so far in 2023, which is the strong performance of some of the US technology companies. So in your top 10 holdings, you've got Microsoft and you've got Apple. Do you own any of the other big US names?
No, we don't. You're right, we own Microsoft and Apple, and they're quite sizable positions for us. But of those other sort of high-profile names, no. Mix of reasons, really. Some of them are to do with responsible behaviours and ESG risks. So, for example, Facebook, I don't think realistically is one that would fit with us because of some of the challenges that come with its business model. And then there are other companies where our view would be there's a bit of a question about the durability of their business model on a 10-year view. They have a great time now, but there might be questions on them further out. Others of them simply don't pay a dividend, and we're believers that dividends are fantastic in terms of enhancing your returns and delivering you some of that income. So our preference is definitely for both Microsoft and Apple. We think they're both fantastically well-run companies. They still have a lot of growth to go ahead of them, cash generative, committed to resilient dividends. Was visiting Apple in California last year, and when you can see on site what it's capable of and what a great company that is, my view is that's a much better fit for our clients in the long term than some of those other ones.
And of course, a key driver of those share price gains for those US technology companies so far this year has been the excitement around the potential of artificial intelligence. What's your thoughts on artificial intelligence as a theme?
Well, it's an interesting one because over the years there's a lot of exciting new technologies that have come, and they don't always last. 3D printing has turned out to be a bit more of a niche than perhaps some people thought. Blockchain, cryptocurrencies, and so the initial question for us is this real? Is this going to last? Is this durable? And our view in case of artificial intelligence is there's a very good chance of it, actually. It is genuinely interesting. One thing I look at is who is endorsing the technology. I would say, so let's take cryptocurrency. A lot of the endorsers of that they're now under arrest, frankly, whereas something like AI is endorsed by Bill Gates, who's got a pretty good track record of calling technology, and he says this is the most transformational technology I've seen in the past 30 years. So we're taking it very seriously as an investment opportunity, really, for our clients. And we've got 3 names in the portfolio which are clearly likely to be beneficiaries of it. One is Microsoft, which, as has a very strong position through OpenAI and ChatGPT, and an incredible network to be able to push that out and benefit from that. Another one is TSMC, which is making a lot of the chips that will be required for the high level of compute that goes here. Another one which nobody talks about, I think is really interesting, we own a company called Schneider Electric, which is the world leader in electrification kit. If you think about data centers and the computing crunch that needs to happen, that requires a lot of energy. And the people who are the leaders in supplying a lot of the electrification and energy boards around those data centers is this company Schneider, which again is in our portfolio. So we think it's real. We believe we have well-positioned companies to benefit from that trend, and let's see how it plays out over time.
And is there another theme in the portfolio that you're playing at the moment?
Another one that we're big believers in is the green energy transition, that is going to happen. There's such a confluence of different reasons for that to take off and be a real thing, to do with part of it is obviously climate, regulation changes. Part of it's to do with the way technology is evolving and bringing down the cost of some of those renewables and other ways of doing things. So lots of different factors coming together to make us think this again is a decade-long tailwind for our clients if we can invest in great companies that are beneficiaries of that. So examples there in the portfolio, I mentioned Albemarle, the world's leading lithium producer. We own a wind turbine company. And again, a few different ways in the portfolio where we see a really long-lasting, meaningful tailwind that should drive growth in profits and dividends for our clients.
And finally, a question that we ask all fund managers that we interview: do you have skin in the game?
Yes, absolutely. So it's a portfolio of great growth companies that I genuinely believe in, managed for the long term, responsible standards. So absolutely, I have a lot of my savings invested in the Responsible Global Equity Income Fund.
Thank you for your time today.
Pleasure. Thank you for inviting me.
That's it for this episode of Insider Interview series. You can check out the rest of our interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you again.